and welcome to Indianomics. In the past week, the sale of SR Oil to Rosneft has made the business news media and stock markets to wax eloquent on the sale of assets by the bad borrowers of corporate India and how bad boys are turning good and spoilt balance sheets of banks are slowly returning to health. Here's an impressive list of the sale of assets by leveraged borrowers. The SR Group, which probably owes Indian banks over 1 lakh crore rupees, sold SR Oil for 86,000 crores. Indian bank exposure to SR Group came down by probably 40,000 crores. JP Associates, which had total debt of 75,000 crores a year ago, has sold cement and power plants worth nearly 35,000 crores. The Anil Ambani Reliance Group, which had debt of over 1.3 lakh crores, has sold or is in the process of selling nearly 25,000 crore of assets of cement, roads and towers. The Lanco Group, which has 35,000 crore of loans, has sold power plants to the tune of 7,000 crore rupees. The GMR Group, with debt of 43,000 crore rupees, has sold stake in power units for about 2,000 crore rupees and road projects for over 1,000 crores. GVK Infrastructure, with loans of nearly 24,500 crores, has sold stake in its Bangalore airport for 2,000 crore rupees. Total asset sales by just 5 indebted groups in the past year amounts to nearly 1.6 lakh crore rupees. We are counting big asset sales, but we are counting even bigger debt. So, how much is left on the balance sheets of banks? Are they at least somewhat de-stressed? That is the question I'm asking an elite panel of analysts who are joining me. Ananda, Bhoumik, the Managing Director and Chief Analytical Officer at India Ratings and Research. Krishnan Sitaraman, Senior Director, CRISIL Ratings. And Saurabh Mukherjea, the Head of Research at Ambit Capital, is with me in the studio. Let me start with you, Saurabh. Well, first up, has there been any genuine reduction in the stressed loans of banks? Because from the list it looks like healthy assets have been sold. Any de-stress at all?
I think the way to look at it is obviously the good news in terms of some of these disposals that you mentioned, Latha, makes it to the headlines. But the underlying rot which continues in the balance sheet of banks obviously doesn't make the headlines. Now the reality is there's not really been any economic recovery in India. So as a result, the total corpus of stressed assets in the banking system I think is still in the vicinity of 15% of system assets. Broadly the same
8 lakh
figure.
crore?
Yeah, so broadly the same figure that it was in percentage of assets terms compared to 2 years ago. Another way to look at it is that stressed asset accumulation is continuing roughly at twice the pace at which banks' loan books are growing. So loan book growth is around 8 to 10%. Our reckoning is stressed asset accumulation is having more in terms of 15 to 20%. Over and above that, as your stressed assets get older, the provisioning quantum on that is rising. So in terms of the hit on provisions, we reckon in terms of provisioning cost, provisioning charges, we'll have at least 2 more years of elevated provisioning for banks. Now, how much of this is the banks' fault, how much of this is because of the fact that the economy isn't recovering is a question of attribution. But I think in all fairness, the candid truth will be that over the last 4 to 6 quarters, I don't think we've seen any abatement in financial stress in the systems. Some of the headline grabbing asset disposals aside.
Okay. The growth of NPAs or stressed assets is at twice the pace of the growth of loans. Point taken. But is it peaking off?
So the answer depends on how you perceive 2 very troubled sectors. The 2 sectors are steel and power. So most people out there would believe with some degree of fairness that MIP, the minimum import price structure, has had some bearing on alleviating stress in steel. But from what we can see in power, things are going from bad to worse. Although it doesn't really seem to have helped the power sector that much. Plant load factors remain low and the power sector stress continues. So you've got 3 dynamics at play. In terms of your quantum of stressed assets, the number is growing in rupee billions. Within the stressed asset pot, the provisioning quantum is going up. As a result, the P&L hit to banks will stay elevated right through this fiscal, and I'm reasonably sure right through next fiscal as well. The only get out of jail card I can see is if the power sector can be turned around. If the power sector can be turned around, we could address the rot. But barring that, I think we've got 2 more years of elevated provisioning costs hitting Indian banks.
So I take your point, and Krishnan and his team have just presented a report on Uday and its impact on the power sector. So we will get to that in a minute. Krishnan, what is your estimate of the banking system's rot itself? I take on board everything that Saurabh has said, but at least for me, the contours of the problem is drawn. Yes, you have to provision more and therefore find more capital, but that 15% of the total banking assets that was stressed is not growing to 15.5. Have we at least ring-fenced and put a number on that?
Currently, we are by and large in the recognition mode, and what we have seen so far is what has been recognized as NPAs and or restructured assets. That is in the region of 9 lakh crores or a little above that. And of course, there are certain other assets which are yet to be recognized as NPAs, which can be classified as weak assets. But I would broadly kind of tend to agree with you that we are not expecting to see slippages which are higher than last year. So if you go back to FY15, the slippages to NPAs on an annual basis were around the 3% mark year on year. FY16 it was around 6%, almost doubled, and this year we are expecting it to be a little over 4%. So it will come down from what we have seen in the last year, but it will still take some time to go back to a long period average. But the asset sales that you're talking about, at least it gives us some cause for optimism or hope that going forward, the issue, the steps towards undertaking resolution of the issue are being visible to some extent. However, the extent of the stressed asset is still at a very high level, and the kind of asset sales which are happening are incrementally happening, steps in the right direction, but it will still take some time before it can make a meaningful dent into the extent of stressed assets.
Okay, so we know that the number of loans that are not getting paid back is 9 lakh crore in the system, out of a total bank balance sheet of 100 lakh crore, 100 trillion, and of which the corporate loan book or loans to industry is about 60 lakh crore. Out of that, we know very well that 9 is not getting returned. My point is, how much of that 9 can now become 8? And that is what Krishnan means by resolution. Well, we all know that assets have been sold, and I have a rough number of about 1 lakh crore from the troubled boys itself. Ananda, how much of that is coming back as capital to resolve the bad assets? Because if the promoters bring in the capital, for instance, if the Ruya brothers brought in that 10,000 crore as capital into SR Steel or SR projects, then the banks can restructure those loans. How much is coming to de-stress, you think? Ananda.
I think that's the point. While the resolution and the recovery through sale of good assets is certainly very encouraging, it could be as much as 15 to 20% of stressed assets being realized via asset sales. JP, SR, I think Videocon had done some sales, so those are good signs. But how the money is being used is critical. Our sense is from the deals that's been done in the last couple of years, I think most of the funds, of course, are partly is being used to delever, but I don't think much is coming into these weaker operating companies by way of additional support. In fact, what we are seeing is, for a variety of reasons, including the weak economic turnaround, is that EBITDA in these companies effectively remain where they are in the weak operating companies, in the stressed companies. Debt levels actually go up. And so therefore, it's difficult to surmise that of these stressed companies, there's any meaningful chance of their moving away from the stressed category into a better performing category. So banks have delevered, which is a good sign. To some extent, therefore, the quantum of stressed numbers will come down, but the exposures will come down. But as far as the operating stressed companies are concerned, so far I don't see any sign of any meaningful turnaround. I don't think the money is being used to revitalize.
You know, the problem is the exposure is coming down on the good loans. SR Oil was not a bad loan, and your exposure to SR Oil has come down. But is there, of the 86,000 crore that the Ruya brothers sold as an asset, they've got barely 10,000 crores. How much of that will come to de-stress their existing stress, just by way of example? That is the question I want to ask all of you gentlemen back in a minute after this break.